S&P 500 and chill. It's a popular investing strategy on social media, and for good reason. The S&P 500 has absolutely crushed the competition over the past 2 decades. But can a savvy portfolio strategy really be that simple? Or are investors putting their future at risk by pursuing it, especially with tariffs tearing through the markets right now? Well, let's find out. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for our 3rd straight year and counting. I'm your host, Rob Moise, and I'm really excited about today's conversation. I think it's going to spur a lot of conversation amongst passive index investors, maybe give some people a gut check on their portfolio, given what they've been seeing online and what they're seeing in the markets right now. So let's get right into it. Joining us is Veronica Popova, a portfolio consultant with Vanguard. Veronica, welcome to the studio. Great to have you here.
Thank you. It's great being here. First time in the studio.
Yeah, it's pretty swanky, huh?
Yeah, love it.
Great stuff. And it's really timely that we have you here now because the S&P 500 is actually down on the year right now. And we've seen the Canadian markets, some of the international markets riding a little bit higher now. So it's kind of interesting that S&P 500 and chill, sometimes it goes by the monikers like VFV and chill or VOO and chill. These are Vanguard S&P 500 ETFs. You can use it with any S&P 500 ETF, obviously. But these are some of the popular monikers we see online. Maybe this is a moment where some people might have to rethink things here. But listen, before we dive into the pros and cons of this strategy and stuff like that, just maybe give us a lay of the land here. S&P 500 and chill, what is it? How would you go about executing it?
Well, I guess I would break that answer down to 2 things. So first of all, what is VFV or what is the S&P 500? So a lot of people know, maybe they've heard of the index, the S&P 500. So essentially it is the 500 largest stocks in the US stock markets. And the companies that are in this index that this ETF holds, they are market cap weighted. So the size of that company, that's going to determine its weight in the actual strategy. So you get larger companies having larger weights, and that's similar, or I guess not similar to, but in comparison to an equal weighted strategy where they might be equal weighted across all companies. Both kind of market cap weighted or equal weight have their pros and cons. I wouldn't say one's better than the other, but just knowing the risks and the differences is important. Now, the and chill part, I guess, what does that strategy of VNF and chill entail? It really means buying that stock or that ETF, buying that ticker, holding it, and chilling, literally buy and hold strategy. Just a new cool way of saying buy and hold, which we've been kind of talking about for years.
Right, and it kind of simplifies a portfolio down to just one ticker, which is an S&P 500 ETF, and then all you're doing is kind of regularly contributing to it over time, and you're just tuning everything else out, right?
Exactly.
Yeah, so why do you think this strategy has become so popular, particularly amongst like younger investors who are online, they might be on Reddit, other social media? Why is it so popular?
So I think there's a lot of reasons why it's been so popular. One, for sure, it's at low cost. It's really attractive, especially for younger investors, newer investors, lower risk tolerance investors that are just looking more for, they think low cost equals the best approach for them. It's very simple. They're just buying that one ticker. They don't have to worry about, okay, which companies am I buying or which ETFs and what weights am I holding them in? It's just literally one ticker. So it's simple, cost effective. Another thing is I think a lot of people are just really resonating with the Vanguard brand and Vanguard's focus on clients and DIY investors, and providing products that are as low cost as we can possibly make them. I think that's really resonating. You mentioned that there's a lot of other S&P 500 ETFs, which there are. I think that all those reasons is why VFV has specifically become to be the largest ETF in Canada.
Right, and you can execute this S&P 500 and chill strategy with any ETF, but certainly Vanguard is one of the popular providers. To borrow another Reddit term, give me the TLDR in your view. Like, is S&P 500 and chill, is this a strategy that can be a savvy approach, or are investors missing something, particularly with all the market volatility we're seeing?
I definitely would not call it a savvy strategy in itself. I think for all the reasons why it's become so popular, that's also the reasons why it's not as much a of a savvy strategy because it's oversimplified. You're really just getting you're not getting diversification. You're just exposed to one market, which is the U.S. market. Do I think it can be savvy combining it with other kind of ETFs, building a portfolio? Yeah, it can definitely be savvy if you're using it as a building block in your portfolio. But kind of touching on the reasons why I think on its own it's not. Not only is it not diversified across many regions outside of the US, but it's also only invested in the stock market, only in equities. So it's assuming that whoever's investing in the VFE and chill strategy, they have a very high risk tolerance, that they can have a 100% equity portfolio. And that is why I don't think it's a savvy strategy. I think when you talk savvy strategies, you're combining different ETFs, different weightings to align with your goals and your risk tolerance.
Right on. Okay, so we're going to dig more into some of the pros and cons here in just a moment. But if you're watching at home here and you want to get in on the conversation, we'd love to have you because we have a live Q&A segment coming up later in the show. So submit your questions and we'll pose them to Veronica. We'll get to as many as we can in the show here today. If you're watching us on Webroker, use the chat box and you can send your questions to us that way. If you're watching on our broadcast platform, use the questions and comments box on the right side of your screen there. And if you're watching us on our YouTube live stream, you can click on the link in the description and it's going to take you over to our broadcast platform and you can ask your questions there. Okay, so Veronica, you touched on some of the ways that you would go about executing the S&P and chill strategy here, and some of the pros and cons. But give us a more detailed rundown of what are some of the pros, I guess, in favor of this thing.
So I guess the pros are kind of aligning with why the strategy has become so popular. So I did mention that it's not diversified across different regions and asset classes, but I will say it is still technically diversified because it's investing across 500 of the largest companies in the US. So that is a good thing. You're not just buying a handful of stocks on your own, which I know a lot of DIY investors might be doing as well, and I'm sure they can see the impact in their portfolios whenever there's any movements that happen. The other reason why, I guess, the pros of it and why it's become so popular is the performance. So obviously we've become familiar with the U.S. equity market, how well it's done over the last, I want to say 10 years, but also even longer than that. You go decades back, and I think overall the S&P has done about an annualized return of about 10% a year. So all in all, it has provided, now I'm going to correct myself right after I say this, but it has provided somewhat stable, consistent returns. Now, by that I mean that there are periods where it's flat or it's down, but it has proven itself to kind of come back from that and over a longer term period, which we as investors love looking at things over the longer term, not just seeing how something did over 3 months or a year. And that's where we see the US market had prevailed, and the S&P 500 has done well for investors in their portfolios. So I think in terms of that, the other part about the diversification is that it's also providing investors exposure to the US dollar. So not only is it invested in US companies, but that has definitely helped boost the return for Canadian investors. Being invested in VFE or any other S&P unhedged strategy gives you exposure to the US dollar. So that has also helped with returns as well.
So people will look back on those numbers and say, yeah, I've seen a similar figure, about 10% a year annualized for something like 150 years or something like that, which is pretty darn good, all things considered, right? Mm-hmm. But what's behind that outperformance, especially in recent years, I'm talking about the past maybe 10, 15, 20 years?
So I would say there's been a lot of things that have fueled the U.S. market's outperformance. Obviously, strong earnings, productivity and labor have been really good in the U.S. Stronger balance sheets, reduced margins have all been good for the U.S. and U.S. companies. But obviously the elephant in the room is the tech companies, which is a big part of the U.S. market. And I think that was one of the biggest competitive strengths it had relative to other markets. So Apple, Microsoft, Nvidia, those were all U.S. companies, and they've been dominating the global market. So the U.S. has really benefited from having those kind of companies in its indices.
Yeah, and those monster tech companies were actually some of the ones that we saw reach these really high valuations, astronomical prices, and then they actually took a pretty big hit recently with this market downturn that we've seen in the S&P 500. That sort of volatility that we've seen in these tech stocks, what do you think that says about the validity or the security, if you will, of the S&P 500 and chill strategy?
Yeah, well, exactly what I mentioned about the cons, that it's not diversified across other regions, because year to date, everybody's looking at the the US market, and they're seeing the headlines, and the headlines are always about the same companies, the Mag 7 and a couple others. But what they're not seeing is that outside of the US, a lot of companies are still doing pretty good. International markets, developed European markets, they're up year to date, some of which are actually up double-digit returns, and it's only March. So that just goes to show why it's important to be diversified across many other regions, not just in the US. A lot of people also have, I would say, recency bias to them, where they are only familiar with how the US has done over the last 10, 15 years. They don't know, or they don't remember, or they just never really looked that far, how the US did during what's called the lost decade, between 2000 and 2009, where the US's returns were pretty much flat, while emerging markets and developed international markets were up double digits. So I think, looking beyond the recent performance, looking at longer term periods, and not just longer term from start to finish, but different periods throughout history, we can see where the benefit of diversification really helped investors.
Right, and I think for investors with a shorter time frame, that can make a lot of sense. But I could see, some of the proponents of S&P 500 and chill making a counterpoint to that. And we actually have a chart that illustrates this that we can show called Staying the Course. And it looks at the S&P 500 over a long period of time. And we've had all these pandemics and wars and recessions and all these terrible things that could have thrown it off course. And yet here we are with the S&P 500 over the long term, annually producing about 10% return per year. And like I said, that's pretty good for a lot of people. Somebody might say, well, hey, look, I'm a young investor. I have a long time frame. Why can't I just hold on for the long term? Why do I even need to care about the volatility like that? Why do they need to care?
Well, in your chart, and also you mentioned 150-year period where the S&P has had those 10% annualized returns. I guess the first thing is, no one really has a 150-year time horizon, right? So you got to think, even though you have a long time horizon, how long is that time horizon? So again, coming back to that lost decade, if an investor in, let's say, even the mid-90s, early 2000s had put their money in the S&P 500, and for them, maybe they had a long time horizon of 10 or 15 years, they would have been much better off invested in international markets. And I will also add that, of course, past performance is not an indicator of future returns. Things can always change. And I think that's also why, young investors can look at the strategy and think, what, VFE and chill, that makes sense for me. I'm going to just go for it. S&P has done really well. US market's done really well. But it is all about, if it does have those amazing returns, then yeah, you're good. But there's a chance that it won't. And that's why you need to be diversified.
So what are some of the things that they would need to think through at their own personal situation that would tell them, I need to care more about diversification, or maybe I could take my foot a little bit off the diversification pedal? What do you think? Well,
I guess going over the basics, obviously their goals, are they longer term or shorter term goals? And that all ties into their risk tolerance. And again, also with their goals, it comes down to what their liquidity needs are. Are they buying a house next year, or are they planning for their retirement in 40 years? That all kind of ties to why you might be okay in a 100% equity strategy, but with 100% equity strategy in one market, I think that's an even added risk that you're taking. I think if you're comfortable with seeing your portfolio down while the international markets are up during volatility, and you're okay with that, knowing that, oh man, I should have had my money in international markets or Canadian markets or whatever else, then I guess the strategy is good for you. But I know most people probably don't want to see that. They want to see a leveled out approach happening in their portfolio, and maybe some downside protection, where if you're looking at the S&P and it's down 10%, you can say, oh, well, I'm only down 2, or I'm actually up 3%. So I think it all kind of ties together.
Mm-hmm. Yeah, I mean, listen, I'm working on the 150-year time horizon for me personally. I hope to be a cyborg one day. Maybe we'll be able to make it there. But yeah, most people, are not investing that long. Even if you're investing for retirement, you're not investing on these super long
exactly
time frames, right? Yeah. So more to think about. Okay, that's a good point. Now, speaking of concentration risk that we were talking about with some of these Mag 7 big tech stocks and stuff like that, I actually have a trivia question for our audience around that I want to throw out there. And the trivia question goes like this. What percentage of stocks included in the S&P 500 index actually outperformed the overall index in 2024? And we have some choices on screen there: 14%, 28%, 49%, 71%. We're going to reveal the answer in just a moment, but Veronica, would you care to venture a guess or maybe drop a hint for our audience here?
I hope I don't get it right because people are going to think that you slipped me the answer. But definitely not the last two because I think those seem a little too high. What were the first two numbers?
14 and 28, I believe.
Let's go with 28%.
28, okay. Well, ding, 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 you are correct.
Oh, no.
Well done, well done. The trivia answer is, in fact, 28% for last year. Only 28% of stocks in the S&P 500 outperformed the overall index. That was actually the second lowest reading since 1980, if you can believe it. And funnily enough, the one that was actually the lowest since then was 2023, the year before, at 27%. So really this speaks to that concentration risk. And I want to pick on something you said earlier. You talked about equal weight ETFs, maybe as a way to get away from some of that concentration risk.
Yep.
Like, tell us about that.
So a lot of investors have been looking to equal weight for that exact same reason, just mitigating their concentration risk to these large cap names that, because of the market cap weighting, are dominating the index. Now, in some periods, equal weight has done well in that case, but I think for people that are looking for downside protection, lower volatility, I personally don't think it's the best approach, and I can maybe touch on that a little bit more, but I'll explain why equal weight comes with its own risks. So because you are balancing out the weight across all companies, you're lowering your weight to those larger cap quality companies that have built their way up. They're able to withstand a little bit more volatility in the economy. They're able to withstand inflation and interest rates, and just, they've been through almost every single possible market that we've seen, right? They've made their way to the top for a reason. Smaller cap companies and large mid cap companies, you're getting a higher weight to them. So that's where you're giving up one risk for another. And I actually did take a look at this over the last couple months, just as the S&P's been down. I thought, okay, let's see if equal weight's done what it was, what people thought it was going to do. I don't want to say what it was supposed to do, and how it did relative to other strategies. And it actually didn't do as well as other strategies that focused on quality companies, value companies, dividend payers. I think if you're looking for lower volatility and risk reduction, look to those strategies instead, because equal weight comes with its own risks as well.
Okay, so equal weight's one option amongst many, but something you're gonna have to carefully consider. It's not like a silver bullet or anything like that.
Exactly.
Cool. Okay. Well, thanks for sharing your perspective on that. I want to get back to some of the arguments in favor of S&P 500 and chill and kind of pick those apart. And one of the interesting ones I've seen online is that if you invest in the S&P 500, a lot of these companies do business internationally. And they're therefore pulling revenues from international markets. And so some proponents of this strategy would say, well, why do I need to even invest in international markets? I'm already getting some international exposure through that. What's your take on that?
Well, Vanguard actually did a paper on that. I believe it was in 2019. And it kind of addressed that same thought. Well, are you still getting diversification from these U.S. companies that are obviously pulling in revenue from all over the world, not just from U.S. customers, right? And it actually found that it wasn't offering the same diversification as actually investing in those international regions. And I mean, to that point, we've seen that play out just this year, right? International companies and both developed and emerging markets are doing much better than the S&P. So if that were true, then we would have seen that diversification pick up or kick in. In terms of maybe why that isn't true, I think it's because companies in different countries have their own strengths and weaknesses, and there's also different sectors internationally than the US, right? In Europe, as an example, they have the luxury goods market, so LVMH as an example. The US doesn't really have that kind of sector, so it wouldn't benefit from any strengths or revenues that happen there. So I think if there are going to be any differences in returns, it's going to be due to the companies and the sectors, and not just where the money's coming from.
Yeah, and that chart that actually we had up on screen there dives into it really interestingly, kind of debunks that idea that people are posing there, because they looked at, well, how do really internationally diversified revenue companies in the S&P 500 do when the S&P is positive, but yet the rest of the international markets are down? And you would think, okay, well, it's going to be somewhere in the middle because they're splitting the difference. Not the case. Actually, in fact, it just followed the performance of the S&P 500, whether it was up and down. So interesting in that respect to kind of poke holes in that.
Yeah.
Another argument that I've heard in favor of S&P 500 and chill is this idea that the Mag 7 tech stocks are just so powerful. They have such a dominant position in the market. They have oodles of cash. They can just buy up competitors and stuff like that. They are, the idea goes, destined to continue to outperform. What do you think about that idea?
You know, I do talk to a lot of people about this that say, oh, we're in for another 2000 Y2K tech bubble crash. And I go, honestly, I don't think that's the case. We're in a very different environment. These companies, as you said, they're very strong. They have cash on hand. A lot of them are even paying dividends now. They have earnings, and their earnings projections actually haven't even come down as much given the volatility that we've been seeing and their prices coming down. So, you know, to that point, they also still have their own risks. So do I think we're going to have a repeat situation of the year 2000 and the crash that happened then? Probably not, but these companies, no matter how strong they are still exposed to their own risks. They're in very innovative industries where new competitors, new entrants, especially those in China, are coming out and coming up with new ways of doing things, cheaper, faster, better. So, you know, back then we had companies that were also at the top that don't really even exist anymore. 10, 15 years ago, everyone had a BlackBerry in their hand. Where's that company now? Everyone has an iPhone now. So who knows, 10, 15 years from now, maybe Apple's not at the top anymore. Maybe Apple's stock is completely different than what it is today, and a completely new company that you may not even have heard of yet is the new leader, right? So that being said, because these companies have done so well, their valuations are very high. So that's just another thing to consider, is that because the valuations are so high, it's just an added risk. There's more room for them to fall and come down, and any news that comes out questioning those valuations, the stock market is forward-looking. So it's kind of already priced in everything that we've seen with these companies, the good earnings, the good revenues. So that was already priced in. So any news or headline that comes out that questions that causes the stock to drop, sometimes double digits. So we saw that actually with the day that DeepSeek came out, that they can do AI much better, faster, cheaper, takes them less time, and the whole tech sector pretty much came down. And that was because that threat of a new entrant really questioned the prices, the valuations, and all that. So I think that's just another thing to think about as well.
Yeah, so these tech stocks, as it were, the valuations are sky high, even still, even after they've come off a little bit. But for a long-term investor, how should they think about valuation? Like, does it matter what you pay for a stock or an index or what have you, if you're a really long-term investor, as much as it does if you're a shorter-term investor? Like, how should people be thinking about that if they're like, I'm thinking of a younger investor who's pretty long-term in their time horizon?
So the U.S. market has technically had high valuations for some time, and you know, people have always said, "Oh, valuations are so high, it's going to come down, and prices are going to drop." But I do think that it does still matter to some degree. It's more for investors' awareness. It's more just being aware of the risk that is involved with those valuations that are so high. And also, when you are thinking about diversifying, that's fine. You can buy companies that are at really high valuations, but maybe that's more the reason to balance it out with companies or sectors or ETFs that have lower valuations. So just to balance out your risk. So not to say if something is highly valued, don't buy it, it's terrible. That's not the case. You're right. It could keep going up. We don't know that. It's just more for awareness, just knowing that that's another risk, very similar to growth investing in general.
Okay, so speaking of diversification here, let's say we've got viewers are saying, you know what, Veronica, you've sold me. I should be more diversified in my portfolio, something I should think about. But I really like the simplicity of S&P 500 and chill. Like, it really appeals to me. Is there an alternative that they can do that combines sort of that simplicity with international diversification or even asset diversification more broadly?
Yeah, there definitely are those kind of solutions. Some of the viewers on the call might have heard the name asset allocation, ETFs or funds, or a more, I guess, traditional term is maybe balanced funds. So there are balanced and asset allocation ETFs where the ETF itself is buying other ETFs. So instead of you having to go out and pick the ETFs that you want to buy, these asset allocation ETFs, they are buying all these different ETFs in the respective different weights for you. So Vanguard does have solutions like that as well. I don't know if those on the call might have heard of VEQT, VGROW, VBAL. Like, the names kind of tie to how much exposure they have. So for example, VEQT is all equity. Now, it's great because it's giving you exposure to US, Canada, international, but it's still not diversified from an asset allocation perspective. That's where maybe someone with a lower risk tolerance might want V-Bal instead, or there's other type of products out there very similar, but just for everyone to know that those kind of products do exist. If they like the simplicity and the low cost of just that one ticker solution, there's an ETF for that. I think that should be like a slogan. There's an ETF for that.
Yeah, these days certainly there's like thousands of ETFs out there. So frankly, there probably is.
Yeah.
Okay, well, thanks so much for sharing your perspective on S&P 500 Chill. Really appreciate Veronica. And for our viewers, I have a question for you. Do you like free stuff? And do you like free stuff that can boost your investing skills and knowledge? Well, then check this out.
The TD Ultimate Investor Contest is officially live. Canadians can enter today for a chance to win a black iPhone 16 with 128 gigabytes of storage, a check for $500, a book kit featuring 5 educational books on investing, and a 1-hour private Q&A educational session with a TD Direct Investing Education Manager. To enter, visit the TD Direct Investing Facebook page, follow TD Direct Investing, and like the TD Direct Investing contest post dated March 24, 2025. You can also gain a second entry by following TD Direct Investing on Instagram and liking the TD Direct Investing contest post dated March 24, 2025 there as well. There's a limit of 1 entry per entrant per social platform. The contest runs until April 22nd, 2025. Scan the QR code for full contest rules and details.
All right, really cool contest. Make sure you get your entries in. And Veronica, you were saying that you've seen this online already, right? And your friends were talking to you about it too, right? Okay, there you go. So it's making an impact.
Yeah.
Great stuff. So thanks so much for sharing your perspective on S&P 500 Chill. Like I mentioned, we'll have another segment we like to call Hot Takes. We like to bounce some ideas that we've heard from past guests off of you, see if you agree, disagree. How does that sound? You want to hear some ideas?
Let's do it, yeah.
All right, let's get into it. The first one comes from Ben Felix from PWL Capital, and he talked about his rationale behind personally investing in an all-equity 100% stock portfolio.
I've thought a lot about what is the true worst-case scenario. Like, is my portfolio of stocks going to go to zero if it's properly diversified? And my thinking on that is probably not. And barring that absolute worst-case scenario, I think a diversified portfolio of stocks for a long-term investor is at least a pretty good bet.
So Veronica, what do you think about this idea of an all-equity portfolio? You mentioned it earlier that there is risk to that. If you're a long-term investor like Ben Felix is, what do you think about that idea?
Well, I think for starters, that approach might work for Ben, considering that he is in a field or an industry that gives him that knowledge about which stocks to pick. I know a lot of individual investors probably don't have the resources, the time, or the knowledge to keep up with certain companies and even know which company to invest in. I know when my friends ask me, what stock should I buy? I say, just buy an ETF. Like you don't know what you're doing, just buy an ETF. It's simple and you're gonna get the job done. I think also with Ben's approach, it doesn't address the fact that maybe for a long-term investor, yeah, you can buy and hold those stocks, but does that include being able to buy and sell those stocks along the way? Maybe for someone that bought stocks 20 years ago, does that mean they wouldn't have added NVIDIA or whatever newer stocks kind of came out? So again, that's kind of where you do need that knowledge to know what companies to buy, what companies to sell off, and I think still buying a full stock portfolio might make sense for some people, but you do need that knowledge to know when to buy and sell and which companies, and that's kind of where it's not a simple approach, at least for maybe DIY investors. Maybe for Ben it makes sense. I can't say it's a bad approach. I'm sure he's probably been successful in it, so yeah.
Yeah, I mean, it does take some legwork, right? Otherwise, you're kind of just throwing darts against the wall, right?
Exactly.
So, okay, cool. Good to get your take on that one. We got one more for you. This one is from DIY investor Joy Yang, and she was talking about how much she likes dividend investing even as a young investor.
I'm not spending those dividends. I'm not pulling that money out to spend, right? I'm reinvesting the dividends. And because I'm younger, I have less capital. And so it's so much easier for me to just invest, $50 here and there or $100 here and there and grow those dividends. And hopefully when I retire, I will have that much capital in the dividend stocks that will pay me.
So Veronica, what do you think about dividend investing for young investors? Can it make sense, or might they want to consider a different approach?
I think it's a great approach as long as you are making sure to reinvest those dividends or have your drip turned on in your brokerage account, just so your dividends that you got paid out doesn't just stay in cash, which I know a lot of people forget about and say, oh, wow, I've accumulated a couple $1,000 in dividends and it's just been sitting in cash. So I think that's where that approach might have a fault. But if you are reinvesting those dividends, listen, like I mentioned, with dividend companies, a lot of people invest in them because they provide some quality in the portfolio, lower risk. These are companies that have been around for a long time. They have cash on hand to be able to pay dividends. So it is a great approach to investing. And I think that as long as you're making sure to reinvest the dividends, it seems like it's good to me.
All right. So a little vindication there for Joy Yang, who sometimes gets some flack from investors saying, hey, look, dividend investing is for old people. So she differs in that opinion. Anyway, so if anybody wants to check out those episodes that we mentioned there, as well as past episodes, we do have them all available in the Learning Center in Webbroker, as well as on TD's YouTube page. So make sure you check those out. All right, Veronica, earlier we talked about sort of this idea of diversifying your portfolio internationally and across asset classes and stuff like that, even if you want to keep things simple. So I'm going to throw it over to my colleague, Caitlin Cormier, and she's going to fill us in on how you can screen for international index funds in Webbroker.
ETF screener tool in Webbroker can be used to screen for all different types of ETFs. To get to it, we're just going to come to Research, Tools, and then Screeners. Once we're here, we're going to click on the final tab, which says ETFs, and then we're going to go ahead and create our own custom screen. Now, in here, let's start out by looking for some global ETFs. So let's start with choosing the fund category. And let's choose global equity. They are alphabetical, so you just have to scroll through. Next up, let's go ahead and choose index. And let's choose show only index funds. And I'm going to deselect mutual funds from within the results. So we're down to 29 matches, which isn't too bad. So let's go ahead and view those matches. So what we can see here is a number of different types of ETFs that are in the international space. So they're looking at investments potentially within North America, but majority of investment outside of North America. So it's just sort of a little bit of a way to see where an individual ETF might be invested. And if you click on this, as I just did, holdings allocation and geographic region, you can see exactly where these individual investments are diversified, whether it is some in North America or majority in other parts of the world. So lots of information you can see from this screener page to get an idea of where these ETFs are actually invested. If instead you're looking for something in the asset allocation type of investment, we could go ahead and choose to show no index funds. So we would look for something more specifically that is an asset allocation fund. And then potentially, let's go ahead and choose our management expense ratio. And let's just go with a lower average to lower management expense ratio and click View Matches. Now that we're in here, you will see there are a number of different ETFs that are available that are in that asset allocation space. So they're looking to be diversified as well as within different asset classes. Again, if you click on holdings allocation, geographic region, you can see where these individual ETFs are actually invested. And there's quite a bit more information about these ETFs in here, including how long they've been around, any ratings available, performance, and risk information.
All right, thanks so much for that, Caitlin. Appreciate you filling us in on that. And Veronica, that's all the time we have for the interview portion of our conversation, but we're not done yet. We're going to take some questions from our viewers. So you ready to hear what they want to know more about?
Let's go. Let's do it.
All right. I like it. The fighting spirit here. Let's see what we got here. We got one coming in from Bill. And Bill wants to know, what are the disadvantages of investing in the S&P 500 in the current market specifically?
So I guess something that we didn't really touch on specifically was right now why the S&P 500 has been a little volatile. There's a lot of risks currently around the U.S. market, as we've seen with tariffs, potentially impacting inflation. Fed might not be wanting to cut interest rates. So these are all things to think about. However, I know a lot of people do have quite a maybe a negative view on the U.S. this year, but I don't think it's as negative as some people make it out to be. I still think companies are doing well. We've seen their labor market is still strong. There's a reason why the Fed hasn't wanted to cut rates anytime recently. So I think, there's just a lot more risks and uncertainty. The stock market doesn't like uncertainty. If tariffs are set in stone and this is what they're going to be, I think the market can, I don't want to say recover, but it'll be a little more tamed, not as volatile. It's just the market doesn't like not knowing what's going to happen, and that's what's going to cause a lot of up and down movement. Not to say that that's all going to impact the market downwards. Again, we've seen a slight correction over the last week. So same way it could drop a lot, it can also go up a lot. So as long as you're comfortable with volatility and just knowing the risks of investing in the US market, just another point on that, a lot of people are concerned about the high US dollar right now. We're used to the US dollar being higher value than the Canadian dollar, but right now it's definitely at its peak within that fair value range. So a lot of people can look to hedge strategies if they still want to be in the U.S., but they want to offset some of that currency risk. There are hedged versions of the S&P 500 ETFs as well.
Can you talk a little bit more about that hedging versus non-hedging? Like, what should an investor think about when they're making that decision whether they want to go hedged or unhedged if they have an S&P 500 ETF, for instance? So long term, we do believe that being unhedged in the equity market, again, for someone invested in equities, you could probably handle risk. You probably want the risk. The U.S. dollar strength has definitely added to VFV's returns relative to its unhedged counterpart, VSP. But right now, as I mentioned, that higher range for people that do want to be tactical, again, for people that have the knowledge and the ability to know what's going on in the market and wanting to make some changes, they can go from VFV to VSP or whatever other strategy that they're in that's unhedged, going into the hedge version. There's a lot of other strategies out there, even international strategies that are unhedged and have hedged versions as well. So yeah, it can add to returns, but at the same time, it does add to a little bit more risk. For us, it's just knowing that we have the solutions available for clients to make their own decisions of what they're comfortable with. And like I said, longer term, we do think that being unhedged in equities is the way to go. Okay. Thanks for that perspective. Let's keep the Q&A rolling here. Lacey Ann has a question for us, and she wants to know, what is a good starting amount to invest in for someone who's in their 30s with a couple $1,000s to invest? What would they start out with, do you think?
That is a great question. All my friends love to ask me that and say, after they see the S&P 500 doing amazing, like, oh, I want to get into it now. So they say, okay, how much should I put in? Personally, I think if you have the funds and you don't need them right now, you're able to set them aside and invest them, go for it. Invest it all. If you want to mitigate some of that risk, obviously you're going to want to diversify, not just in the S&P 500, but some other ETFs as well. Just diversify yourself a bit. But I have other friends that they like to put in maybe a couple $100 at a time. And that's what's known as dollar cost averaging, where you're averaging out the price that you are paying. So some people might believe that through that they're reducing the risk of buying at the top potentially, but at the same time it's kind of like timing the market, which is very difficult in itself and a risk in itself. But studies do show if you have the money, put it in right away so that you don't miss out on any market returns.
Yeah, it kind of goes back to that idea of like on paper it might make sense to just lump sum things, but we don't exist on paper, right? Like sometimes people will feel better dollar cost
exactly.
averaging.
Exactly. Do whatever makes you feel good and comfortable about your money.
Right. But if you have the money to invest and you can afford to invest it, go for it.
Yeah.
I like that message. Carrie has a question coming to us. She is wondering, can a Canadian DIY investor purchase a US dollar Vanguard ETF?
Yeah. Definitely. There are obviously the different, I don't want to say risks, but just for investors to be aware of. When you're investing in US dollar ETFs, I don't know exactly, and I don't want to speak for TD how it works, but your money does get converted to US dollar, and sometimes there is an FX fee. So for Canadian investors, we do recommend to just invest in Canadian denominated funds. then there are some potential tax implications as well if you're investing more specifically in U.S. funds that hold international ETFs. So there's the issue of double withholding tax, where it gets taxed when it gets to the U.S. and then when it comes to your Canadian account. But that's more so for international based securities or funds. So yeah, just being aware of the benefits and I don't want to call them risks, but just being aware of, it might cost a little bit more to buy the US dollar one.
Mm-hmm. Yeah, and lots of providers also have like hedged, unhedged US dollar, Canadian dollar versions of like S&P 500 ETFs and all kinds of ETFs as well too. So that was a good point. You mentioned withholding tax. Oh boy, we love talking about tax here on all these things. But what could somebody do to avoid that withholding tax? Is there any way that they can do that depending on like where they hold that ETF or anything like that?
So in an RSP, it is sheltered from that double withholding tax, or like I said, you can buy a Canadian ETF that invests directly in those international securities. That's a good thing to do as well, but I'm definitely not a tax expert, so please consult with your tax experts and accountants and yeah.
Yeah, for sure. It can be product specific in some cases too, so make sure you look into that.
Yeah.
Patrick has a question for us. Patrick is wondering, is the 15% US withholding tax a real issue when deciding to use something like an S&P 500 ETF? In other words, can you just kind of like look through that noise, especially if you're a long-term investor? It's like, it's 15%. It's on dividends generated by the fund, right? So can I just look through it, or?
So yeah, for longer term investors, that might not be as much of a concern. Again, depending on what account you're holding it in, your situation. So in that situation, it's probably not as much of a concern.
Okay. Holly's got one for us. Also kind of feeding into like something that we had mentioned, but wondering, is investing a large lump sum into the S&P 500 index at once okay during these high valuations, if her time horizon is something like 40 plus years? So she's a young investor and she wants to know, again, can you sort of look past some of those valuation concerns?
So if you look at the chart, and not just with valuations, but a lot of people will say, I don't want to invest in the S&P 500, just hit all-time highs. It's always hitting all-time highs. It is literally always, if you look at the chart, it's going like this at every point, it's all-time highs. So I think that is, of course, a risk in itself, buying at what appears to be the peak, but no one knows when that drop is going to be, when it's going to turn around. You could be saying, valuations are high, or it just hit an all-time high, I don't want to buy, I'm going to wait till it cools off a bit. It could run up another 30% and then finally cool off 5%, and then that same person will be saying, see, I told you it's going to come down, right? I like to use the example of being at a casino at a roulette table. Behavioral biases, people will look and say, you see a lot of red on the board, what's your first thought? I don't want to put on red, it's been red, there's been so much red, I got to go black. Well, you don't know what the next, it could be red again, it could be red another 20 times, right? So I think that's just behavioral biases kicking in, of always thinking, something has happened so much, it's bound to be the other situation. So to answer that question. I
had a friend think exactly that way at a roulette table years ago.
Everyone has a friend.
I've never seen someone lose money so quickly.
Exactly.
The behavioral biases are real. Okay, we have time for one more question. This one's coming to us from a viewer on WebBroker, and they want to know, are there any real differences between the different S&P 500 ETF funds from different providers? Or basically, should I just look for the one that has the lowest management expense ratio, the lowest fees?
I would say when it comes to funds tracking the S&P 500 index, they all kind of do the same thing. You want to be looking at making sure costs are low for sure. And another thing you can look at is tracking error. So for funds that are passively managed and they're just following a specific index, you want to make sure that the manager is staying very close to the benchmark as possible, and that's something that you can find probably on your TD screener and on the ETF issuer's website, like on the Vanguard website, we have tracking error. So you want to make sure tracking error is tight, you're getting the exposure that you thought you're getting, and fees are low. This might not be as much of a concern for S&P 500 funds because a lot of them are very high volume, have a lot of shares, tight spreads. But for some strategies, when you're comparing them, if they're similar strategies, but one has less volume, less fund size, a wider spread, you probably want to go with the one that's easier and better to trade.
And these are all things that you can find on the TD screener tool, I should say. So you have that there available to you. Veronica, that's all the time we have for the Q&A, but thank you so much for playing along, answering all those questions. Great job, and sharing your take on the S&P 500 and chill strategy. Really appreciate it. And for our viewers, thank you guys for tuning in. And you make sure that you can check out next week's episode. Remember, this is Thursdays at 2 p.m. Eastern every week. We're talking tax tips with Jason Heath from Objective Financial Partners ahead of that tax filing deadline at the end of April. Another quick reminder too, make sure you scan that QR code to register for the TD Ultimate Investor Contest. There's lots of great prizes to be won. Make sure you check it out. But for now, that's all the time we have. Thank you for tuning in to this week's episode from everyone here at Inside Investing. Thanks again, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.